All right, let's get right into it. We're going to explore one of the most talked about and frankly feared concepts in finance today, the everything bubble. It's this idea that our entire financial system might be stretched to its absolute breaking point.
It all kicks off with this just staggering number. According to the Institute of International Finance, total global debt recently shot past $324 trillion. This isn't just a record, it's a historic high that's got some of the world's top economists seriously worried.
So, what exactly is an everything bubble? Well, it's the theory that years and years of super cheap debt haven't just pumped up one little corner of the economy. No, it's the idea that almost everything has gotten inflated, all at the same time. We're talking stocks, bonds, real estate, you name it. Prices are at levels that look dangerously disconnected from reality.
Okay, to really get a handle on the risk we're all facing, we need to peel back the onion a bit and see where this mountain of debt is actually hiding. It's not in just one place. It's woven into the very fabric of our global economy.
See, the debt is sprayed all over the place. Governments borrowed like crazy to fund stimulus programs. Corporations took on tons of cheap loans to grow and buy back their own stock. And of course, households like ours loaded up on mortgages and credit cards, all while chasing those rising asset prices. And here's where it gets really interesting. Well, yeah, developed nations like the US hold the most debt in sheer dollar terms. The fastest and maybe most alarming growth is actually happening in emerging markets. And that creates a major point of vulnerability for the whole global system. 245%. Let that number sink in. The total debt-to-GDP ratio for developing nations has exploded to 245%. Just think about that. Their total debt is almost 2.5 times their entire annual economic output. That's a massive, flashing red light on the dashboard of the global economy. So we know there's a record amount of fuel, debt, sloshing around the system, and we know it's pushed asset prices way up. But how can we actually measure just how stretched or, how frothy things have really gotten?
Well, for that, we can turn to a really powerful tool created by Nobel Prize winner Robert Shiller. It's called the Shiller P/E ratio, and what it does basically is it gives us a much better long-term view of the stock market's value by smoothing out all the short-term noise.
Recently, the Shiller P/E ratio for the S&P 500 was sitting at a very, very high 40.1. Now, in isolation, that number might not mean a whole lot to you, but when you put it in context, well, it becomes pretty concerning. Now, here's where it really clicks. That 40.1 is over 47% higher than its 20-year average. And history shows us, pretty clearly, that when valuations get this stretched, major market downturns have often followed. So what does this mean for future returns? Well, the implications are pretty serious. If the market just kind of returns to its normal historical value over the next 8 years, your implied annual return is a measly 1.3%. And if things get unlucky, well, you could be looking at deeply negative returns. This whole combination of record debt and sky-high prices might feel totally new, but history actually gives us a really clear blueprint for what could happen next. We've absolutely seen this movie before. In fact, some incredible analysis of 400 years of economic history, looking at 23 separate episodes, shows that asset bubbles aren't some rare event. They're a recurring and often pretty destructive feature of financial markets. From tulips back in the 1600s, to railways in the 1800s, to tech stocks in 2000, and of course housing in 2007. It's the same pattern of a massive boom followed by a painful economy-crushing bust playing out over and over again. But all that historical research reveals one critical lesson. And if you take away one thing from this section, make it this. The real danger isn't what asset is in a bubble, it's how that asset is being paid for. And this just perfectly illustrates the point. Remember the dot-com bust in 2000? It was painful for sure, but because it was mostly financed with stock, with equity, the damage was kind of contained. But the 2008 subprime crisis, a completely different story. It was fueled by a mountain of debt, and it nearly brought the entire global financial system to its knees. So this whole situation puts central banks, the people who are supposed to keep the system stable, in an incredibly difficult position. They're facing this classic high-stakes debate over what on earth to do next.
Should they try to lean against the wind right now and raise interest rates to try and gently deflate the bubble, even if it means risking a recession, or do they stick to the old playbook and just wait for it to pop and then try to clean up the mess? A strategy that, let's be honest, was a catastrophe in 2008.
The arguments against acting now are pretty powerful. I mean, it's really hard to be 100% sure you're in a bubble. If you act too soon or too aggressively, you could end up choking off economic growth and causing the very crisis you were trying to prevent.
However, the alternative of just waiting is arguably way worse. History shows us that just waiting and cleaning leads to much deeper, much more painful crises. It also creates this thing called moral hazard, the belief that the central bank will always step in to save you, which just encourages even crazier risk-taking down the road. So let's bring all these different pieces together. With all this debt, stretched markets, and history as our guide, what's the big takeaway here? What does this all mean for us? Here's the situation in a nutshell. We have the fuel, a $324 trillion mountain of debt. We have the clear indicators, those sky-high valuations like the Shiller PE. We have the historical precedent, a clear pattern for how these debt-fueled bubbles end. And we have policymakers who are trapped between a rock and a hard place with no easy answers. And all of this leads us to the final, critical question that's on pretty much every investor's and economist's mind today. With all the pieces set up just like this, is the global economy's day of reckoning finally approaching?